in listen-only mode.
Welcome friends and traders, my name's TIAN and I'm your host for today's UTP lesson on strategy 1, 2 and 3, and today is Tuesday the 21st of March 2017. Thank you everybody for joining. Before we continue, may I please just confirm audio and visual. I just want to make sure that the connection is fine on my side as well as on your side. Welcome, welcome, welcome. Okay, beautiful. Thank you, Ricardo. And thank you, everybody else. I trust you had a nice time with Russell this morning. This lesson will last about 40 minutes, and if you have any questions, you're more than welcome to just type it here in your question section box. Right, strategy number 1 is about scalping candlestick formations inside the ABCD price swing, risking 1-for-1. So you're going to have a 1-to-1 risk reward here. Now the first step would be to compress the charts and see if the market is in an uptrend or a downtrend. Then find and mark your current ABCDs, your sub-ABCDs and Fibonacci's on the daily chart and the 2-hour chart. Only trade this strategy in an up or down push zone or an up or down retracement zone on a daily chart. If a signal hits, figure out if the market is moving from a B to a C retracement or a C to the D extension of the recent ABCD uptrend or downtrend. You should only be trading in the direction of the C to the D. Now look at the time and figure out if you're in the active zone or the dead zone. And you can trade these formations, these candlestick formations, anywhere inside the AB boundary or anywhere the market is moving from the projected C to the D, or as it makes sub-ABCDs on the way to the D extension. Now I'm just going to stop over there and let's have a look at a currency pair that may be lining up for a potential trade. And I just want to have a look at my hot pairs workspace, the pairs I was looking at yesterday, to see if there's anything that's lining up so that we can use that for an example. Euro NZD, I'm looking for a sell, but I don't know if that one's lining up. Euro CAD, not in that trade. Euro Yen, this one may be lining up for a sell. Okay, great stuff. So let's have a look at the Euro Yen. And let's open up a daily chart and a 2-hour chart. There we go. And let me just go back to the manual. So the first thing is compress the charts and see if the market is in an uptrend or a downtrend. Find and mark your current ABCDs, sub-ABCDs and Fibonacci's on the daily chart and the 2-hour chart and adjust them as needed. Right, so let's go and have a look at the ABCDs. Now first of all, I want to open up the daily chart. Before I continue, can everybody see the charts here on your screen? You should be seeing a daily chart of the Euro Yen to your right, and you should be seeing a 2-hour chart to your left. Okay, great. Thank you. Thank you, everybody. Thank you, Veronica and Ricardo. Right, now let's compress this and just mark the most current trend. Now we can see we had a downtrend over here on the Euro Yen, and the market has been making lower highs and lower lows, and it's really been honoring this downtrend line resistance. And now the market has broken that downtrend line to the upside. Now potentially the market will come back to actually confirm the break by bouncing at the backside of this broken trend line. So the market may be moving down, bounce at the backside, and then go up again. Right, because the whole trend is changing over here. Alright, so before we get there, let me just take out these lines. Let's have a look at the most recent Fibonacci's. Now I'm going to start my Fibonacci's at this low over here, which is the lowest significant turning point, the lowest low that the market made before it broke the downtrend line to the upside. So I'm going to start my Fibonacci tool at that low, and there we have the most recent up AB boundary. And this is quite an interesting scenario due to the fact that we have an A at 112.06, we have a B at 123.18, and the market actually came back to retrace to the 382, but that's still regarded as a shallow retracement. The market also did break a counter trend line to the upside. So we are heading from the C to the D, but I'm not too confident that the market will hit the actual D extension. It will most probably find resistance at the 127 extension, and then if it moves above the 127 extension, then yes, the market could be moving towards the 1.618, which is the current D extension. However, if I have a closer look over here, there's another downtrend line that I can bring in, which is this most recent downtrend line, and the market has been honoring that downtrend line for quite some time. And the most recent bounce against this downtrend line resistance, so that's resistance at the downtrend line. The most recent bounce against the downtrend line resistance was confirmed by an uptrend line break. Look at that. Market broke the uptrend line to the downside. Now we're going to head down again. Okay. And if the market breaks an uptrend line after it bounced at resistance, and you haven't seen the market give you a deep retracement, and the stochastic is bearish, then it means we still have a down, an up retracement zone. We are faced with a retracement zone over here. And if I have a look at the down sub ABCDs, let's do that. Draw the down subs. There's a down sub AB boundary. Then I can see that, wait a minute, we are moving from the C to the D. Look at this. We have an A at 123.29. Let's just take that out. We have an A at 123.29. We have a B at 109.31, and now we have a deep C, and that deep C is at the 8.6 retracement level. There we go. And if the market retraces to the 8.6 retracement level, then the D extension is going to be the 1.18 at 118.60. So that will be the D. And now, because the market broke a counter trend line, we are heading from the C to the D, and the market has already been making lower lows and lower highs. Look at this. High, low, lower high, lower low, lower high, potential lower low, and so on, until we hit that D extension. This is confirmed with the stochastic being bearish, and this is downside potential for the next 300 pips. Right. So the direction of highest probability is bearish because we are retracing with regards to the up capital AB boundary. We are also moving from the C to the D with regards to the down sub AB boundary. Okay. Is everybody with me up to this point? Does it make sense? Okay, beautiful, 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 beautiful. Thank you. Now, this is the daily charts. Let me just make a note of the fact that that is a daily chart so that you can copy this down for your reference. So this is the daily chart. And now we can go and have a look at the 2-hour chart. Now the first thing I want to do is bring in that daily D extension. And now I'm going to stop selling at the daily D. And there is the counter trend line that's been breached. And now we are heading from the C to the D on the daily. And let's have a look at the most recent down AB boundary on the 2-hour, because the manual says compress the charts to see if the market's in an uptrend or a downtrend. That we did. Then find and mark your ABCDs on the daily and the 2-hour. We already did that on the daily. Now I'm going to do this on the 2-hour. Now because the directional bias probability is bearish, I need to look for a down AB boundary on the 2-hour. And we can clearly see here that we do have a down AB boundary, and the market is about to move from the C to the D. Look at that. We have an A, we have a B, we have a deep C at the 618, and now the market could be moving down. And if it moves down from here, then it will move towards the 1.618, which is going to be the D extension at 11192. So that will be the D. And by the looks of it, this will be downside potential for about 160 pips until the market reaches that D extension. Okay, so clearly the market is bearish at this stage, as seen on the daily and confirmed on the 2-hour chart. Now, let's carry on with the manual. The manual says, only trade this when the market is moving from a C to the D. Well, we can see that the market is moving from a C to the D, or about to move from the C to the D, right? And here's the rules. If the market's in an uptrend, look to buy bullish candlestick formations inside the AB boundary. If the market's in a downtrend, look to sell bearish candlestick formations inside the down AB boundary. And you can enter at the close of the candlestick formation. Your stop is going to be 10% of the daily trading range beyond the candlestick formation. Your limit is going to be to figure out the risk from the entry after the candlestick formation closes, plus 10 additional pips in risk beyond the formation, and then go for that amount in profit. So basically this is a 1-to-1 risk reward. If I'm going to risk 40 pips, then I need to target 50 pips. Okay, so this is strategy 1. Strategy 1 is trading candlestick formations inside the ABCD price swing from the C to the D, risking 1-for-1. Okay, here's an example. There's an up AB boundary. Market's heading from the C to the D. We've got a beautiful bullish candlestick formation over there in the form of a bullish shooting star. I place my stop 10% of the daily trading range below the candlestick formation, and whatever I am risking, I need to go for that same amount in reward. Here's an example of a sell. We have a down AB boundary. Market's heading from the C to the D. We've got a beautiful bearish candlestick formation over there in the form of tweezer tops, and place my stop 10% of the daily trading range above the candlestick formation high. And if I'm risking 30 pips, then I need to target 30 pips. So let's go and have a look at this on the charts. Okay, now first of all, let's just see what is the daily trading range. Let's open up the Forex Tips website. Daily trading ranges. If you want to see the daily trading ranges, there's the link to the Forex Tips website where you can view the daily trading ranges. I've copied and pasted this in your chat box. Let's go down. There's the euro yen. We can see that the daily trading range is 92 pips. That means 10% of the daily trading range is 9 pips. So my stop will be 9 pips above the high of the candlestick formation plus the spread. Right, now let's see what's the spread. The spread is, I haven't linked the trading account. Okay, the spread here is 1 pip. Okay, so my stop will be 10 pips above the candlestick formation high. Now let's have a look at this. There's a counter trend line. As soon as the market breaks the counter trend line to the downside, like that for instance, and I'm just going to draw a hypothetical bearish candle, then it means we will have a bearish engulfing candle. And then we will have a bearish candlestick formation that's confirmed, and I can enter with a sell on the next candle. Right, is everybody with me up to this point? Just up and wire, yes. Now, okay, thank you. Now, I place my stop above the high of the candlestick formation. Now that high is 121.82, so that means my stop is going to be 121.92. 10 pips above. There we go. That will be the stop. And my target, my target is a 1 for 1. My target is a 1 for 1. So how many pips am I risking? If I'm risking 63 pips, then I need to target 63 pips as well. So that's my risk. Then I need to target 63 pips as well. And 63 pips below that is going to be around about 120.63. So the target will be 120.63. And there we go. 63 pips reward. Okay, so this is strategy number 1 in a nutshell. Trading candlestick formations inside the AB boundary, risking a 1 for 1 from the C to the D. Okay, is everybody now familiar with strategy number 1? Just let me know and then we can move ahead to strategy number 2. Great, let's go and have a look at strategy number 2. Strategy number 2 is scalping candlestick formations inside the ABCD price swing to the B high or the B low. So now, the only difference between strategy number 2 and strategy number 1 is that now with strategy number 2, I'm not going to go for a 1-to-1 risk reward. I'm actually going to target the B high or the B low. So first of all, compress the charts and see if the market's in an uptrend or a downtrend. Find and mark your current ABCDs. Do your whole analysis and make sure that you're trading from the C to the D. And this is what we have here. There's the daily chart. We can see on the daily we're heading from the C to the D. The direction of highest probability is bearish. We're going to move down. We're going to move south for the next 300 pips. And on the 2-hour chart, we can also see that we're about to move from the C to the D, right? Because we also have a down AB boundary and we have almost established the C if the market can just break that counter trend line. So there we go, that's the 2-hour chart. There we go. Okay, so we've done our analysis. The rules of strategy number 2 is if the market's in an uptrend, look to buy bullish candlestick formations inside the AB boundary. If the market's in a downtrend, look to sell bearish candlestick formations inside the down AB boundary. Enter at the close of the candlestick formation. Stops, place a protective stop order 10% of the daily trading range plus the spread beyond the candlestick formation. Your limit, find the B high in an uptrend and the B low in a downtrend and place a limit exit order to exit the trade 10 pips before the market hits the B. Right, so buying the C and selling the B high, there's an example. We have an up A, B, C, D. The market moves from the C to the D, gives us a beautiful bullish shooting star candlestick formation. And all I'm going to do here is I'm going to exit at the B high. If I'm selling, I'm trading from the C to the D and place my stop above the high of the candlestick formation. But now I'm just going to target the B low, 10 pips before the market hits the B low. Right, so let's have a look at this picture over here on the 2-hour chart. Let's say, for instance, we get a nice bearish candlestick formation. And I enter over here, then my stop will remain the same. However, my target is going to be the B low. There we go. And the B low is going to be 120.80. And that means I'm going to risk 63 pips to make 45 pips. Typically, I would pass on this trade because of the risk reward. However, I don't exactly know where I'll get an entry over here. I'm going to have to wait for that 2-hour candle to close. But typically, if you get a good entry inside the AB boundary, especially in the sell zone, then targeting the B low should give you more reward in pips than what you are risking. Okay, but there's the fundamental difference between strategy number 1 and strategy number 2. Strategy number 1, trade from the C to the D. No, trade from the C. How am I going to word this? Let me just say trade candlestick formations inside the AB boundary and target a 1-to-1 risk reward. Strategy number 2, exactly the same. There we go. Also trade candlestick formations inside the AB boundary but now you target the B. Okay, so there's the difference between strategy 1 and strategy 2. And now we're going to get to strategy number 3. So let's go and have a look at that one. Strategy number 3 is about trading candlestick formations inside the ABCD price swing, but this time I'm going to target the D extension. Now first of all, compress the charts and see if the market's in an uptrend or a downtrend. Find and mark your current ABCDs, sub-ABCDs and Fibonacci's on the daily chart and the 2-hour chart. Adjust them as needed. Only trade the strategy in an up or down push zone or an up or down retracement zone on a daily chart. Look at the time, figure out if it's in the active zone or the dead zone, and just make sure that you're trading from the C to the D. Right, now here are the rules. If the market's in an uptrend, look to buy bullish candlestick formations inside the AB boundary. If the market's in a downtrend, look to sell bearish candlestick formations inside the down AB boundary. Enter at the close of the candlestick formation. Your stops, place a protective stop order 10% of the daily trading range, plus the spread beyond the A. Just remember, when placing a stop inside the AB boundary, you increase your chances of getting stopped out early by 80%. Then your limit, find the corresponding D extension and place a limit exit order to exit the trade 10 pips before the market hits the D extension. So there's an example. Now we have an up AB boundary, A, B, and now the market moves from the C to the D. We had a beautiful bullish candlestick formation in the form of a bullish shooting star. Place your stop beyond the A and target the D extension. Here's a sell example. Down AB boundary, and now we're moving from the C to the D. Place your stop beyond the A and target the D extension. Right, now let's go and have a look at this where we are now. So the D is over here, so that will be the target. The D will be the target, 10 pips above the D plus the spread. So the spread is 1 pip, so that will be 11 pips above the D. That will be 120.03. That will be the target. This will be the target. And strategy number 3 is about trade candlestick formations inside the AB boundary and target the D. Right. But now I'm going to place my stop beyond the A. The A is at 122.23, and that stop needs to be 10% of the daily trading range above the A. Now we know the daily trading range is 90 pips, so 10% of that is going to be 9 pips, plus the spread is going to be 10 pips, so 10 pips above the A is going to be 122.33. There we go, so that will be the stop. So I am risking so many pips, that would be 103 pips. And now I'm going to target let me put this over there, make space here. I'm going to target 10 pips above the D extension. There we go. So that will be 103 pips risk for 125 pips reward. Right, and that is the fundamental difference between the first 3 strategies that we teach in the Ultimate Traders package. Once again, strategy number 1 is trading candlestick formations, but you target a 1-to-1. Strategy number 2, again trading candlestick formations, but you target the B. And then strategy number 3 is targeting the D extension. Okay, just type a DONE done, and when you've copied this down, you can print it out and stick it against the wall for your reference. And let me know if you have any questions. Okay guys, did you enjoy the lesson? Debbie says, so when do you know which strategy to use? You're going to have to pick a strategy and then stick with that one there, Debbie. Okay. Personally, I don't apply strategy 1, 2, or 3. I like strategy number 7. So we have 7 different strategies that we teach in the Ultimate Traders package. So you just need to pick one that you feel comfortable with, that you enjoy trading. Okay, no problem, no problem. Good question, by the way. Ricardo is asking, when will there be a lesson on strategy number 7? Let me just see quickly. Strategy number 7 on Friday. I'm going to discuss strategy number 7 on Friday. Join me on Friday. Friday I'll discuss strategy number 7. Let me just check if that's actually going to be me. Yes, I'm going to discuss strategy number 7 on Friday. Okay, Veronica says, yes, thanks. I liked seeing the live example. Beautiful. Right, guys, thank you so much for joining me in today's UTP lesson. Thank you for your wonderful participation, and I look forward to seeing you in the Analyst on Demand tomorrow morning again. Right, have a great rest of your trading day. All the best. Cheers.